Hello friends, I'm Kostub and we are back with Economic Survey 2021. Today we'll be discussing Chapter 2, Volume 1. It is titled, Does Growth Lead to Debt Sustainability? Yes, but not vice versa. Now, before going into the specifics of this topic, let us understand the context. It is post-COVID fiscal policy. Now, what do you understand by fiscal policy? It is how the government manages the economy. It is the use of government spending or tax policies to influence the macroeconomic conditions in the economy, like aggregate demand for goods and services, employment, inflation, the growth, and so on. So, it is how government deals with taxation and revenue. The big question in the post COVID context is to spend or not to spend. Because you understand that our economy has contracted. In this, government does not have much revenue. And then if government goes for austerity, that it doesn't spend, it contracts spending, it would be a pro-cyclical policy. It is said that it will not bring back India on the track of growth. On the contrary, if government has to spend, so from where does the government get this money? It has to borrow, and this will lead to rise in debt to GDP ratio. Now, this is the entire context of this chapter. And then, through this chapter, the economic survey or even the chief economic advisor strongly promotes a policy where government shuns austerity and promotes spending even by borrowing. So let us look into this chapter. The survey says that we need to build an economic bridge, a bridge to medium and long term, such that in medium and long term we are able to bring the Indian economy back on track. So he proposes active fiscal policy, which recognizes that risks from doing too little today are much more than doing too much. So here the survey says that even if we spend more, there's no problem. We may increase the fiscal deficit. It may lead to small troubles in the economy later, but not doing or doing too little would be much dangerous to the Indian economy in long term. So that is why it is called the economic bridge. So bringing India back in medium and long term on the growth trajectory that it was supposed to be. What are the concerns? If India follows this policy, spends a lot, and allows the fiscal deficit to grow, what can be the concerns? First is it can have a problem with future growth, where today if you borrow and spend a lot, it may in long term compromise your economy's ability to sustain that growth rate. We'll discuss this in detail in the coming slides. Second is the debt sustainability. This means if you take too much debt today, tomorrow you will have to tax your population more to repay and give that debt back or pay the interest rate on it. So this may lead to difficulty with sustainability of debt. It also may affect the sovereign ratings, where your debt to GDP ratio rises, and the rating agencies would see that you have to repay in time, otherwise your rating will go down, which will also affect the foreign investment coming in your country. And lastly, possible vulnerabilities on the external sector, that taking too much loan may have an impact on the exchange rate, and through exchange rate the pressure may be borne by your economy, where anything that happens outside, your vulnerability to such disturbances may increase in future. Now let us look at some important concepts before we go ahead. The most important concept in the context of this chapter is counter-cyclical fiscal policy. In the diagram, you can see the blue line is the boom, this is business cycle, right? So this is a boom that you see, and this is a recession that you see. Now pro-cyclical expenditure is red line. So if the economy is doing very well, pro-cyclical expenditure, government also spends a lot, reduces interest rate and promotes that growth. So this is pro-cyclical. But the counter-cyclical would be during good times of economy, government should contract its expenditure, may increase the tax rates, and also allow the interest rates to rise. On the other hand, as we are in a recession now, if we see this recession, pro-cyclical would be that government should go for austerity, contract its own spending. But counter-cyclical, that the survey is supporting, is exactly opposite, that government should spend a lot, borrow, spend, reduce taxes, reduce interest rates, and so on. So fiscal policy that goes against the direction of economic or business cycle, that is called the counter-cyclical fiscal policy. Now, another principle that is very important here is the survey speaks about Ricardian equivalence proposition, that's called REP. So, survey says that REP principle is not applicable in the Indian context. That is why we should borrow and spend. Now, what is this REP? Ricardian equivalence proposition. According to this principle, forward-looking consumers who are perfectly rational and perfectly capable internalize the government's fiscal choices when making their consumption decisions. Just to simplify for you, for example, if the government is reducing tax rate, reducing interest rate, borrowing a lot of money and spending that money today, a rational consumer would understand that this is not sustainable in long term. So he or she will realize that in future the government is bound to increase the tax rate, increase the interest rates. Why? Because government would need to take the money back that it had pumped in, and also service the loans that it had borrowed from outside. So according to REP, this consumer who realizes that though the government is spending a lot now, may increase tax rate in future, will try and tend to save the money and not spend it. So this principle says that no matter what the government does, if government borrows a lot and spends now and taxes in future, the overall growth rate remains rather unchanged. So it doesn't have much impact on the economy, because whatever the government does, the consumer is going to act in that fashion looking at government's decisions. However, this goes against what the survey is saying. Survey is saying that the government should borrow and spend. It will lead to economic growth in future. So here, survey is saying that this Ricardian equivalence proposition is not applicable in the context of India. So when survey supports high spending, it says that high fiscal multipliers during slowdown. It says that whenever an economy like India, especially in like developing countries and Indian economy, it is in recession or during a slowdown, the fiscal multipliers are strong, and that makes stronger argument for borrowing and spending now. Now, why does the survey say that? First point, effective in boosting private consumption. So, survey says that today, if government borrows and spends a counter-cyclical fiscal policy, it would lead to greater consumption by people. It would increase the demand in the market. That is why we should spend it. This demand presently is not that high, taking into consideration that because of all the negativity surrounding in the economy now, prevailing in the economy now, people are not spending. Either they have less money or they are trying to save for future because of the uncertainty. But in this uncertainty, if government spends, people will be willing to consume, right? So private consumption will increase. It will boost the demand in economy. Second, encourages more borrowing and spending. So survey also says that the economic, the credit that is available in the economy will increase when government starts spending. So if government pumps up money through the banks, it will reduce interest rates. So it will lead to better borrowing and then spending. So investment activity will pick up. Survey also argues that it doesn't crowd out private investment or employment. See, in developed countries, if government spends too much, it eats into the space of private sector. So either the private investment may be affected, because the more government borrows, and majorly government borrows from domestic sources. So the more government borrows, less amount of money is available for the private players to borrow. So it leads to upward pressure on the interest rates. If that happens, then there is crowding out of the private investment. Plus, many times if government spends more, it will put upward pressure on the wages, and that will lead to difficulty in labor employment by private sector. So this crowding out of investment and employment is a major concern. However, the survey in this chapter clearly shows that in the context of developing country like India, where the private market and public market are nicely fragmented, most of the economy is in informal sector, any greater spending, borrowing and spending by government does not necessarily crowd out the private investment or employment in the present context. So rather, it argues that it would unleash the animal spirits. This means animal spirits in the economy. This means optimism. You see, the stock markets, the bull, the more government is willing to spend, it will unleash this hope and optimism, leading to the private players also putting in their money into the economy as investment, which will generate the virtuous cycle of investment, growth, and investments. So This is an example of credible commitment. What is the meaning here? In the present recession, uh, even if there is less liquidity in the market, whatever is available, the private sector is not ready to invest. The people are not ready to consume. The banks are not ready to lend because everybody fears that the outcome may not be what is calculated. So the economy is going down. At this time, the government has to show its commitment, a credible commitment that yes, we mean business and we are here to protect your investment. This can be done by the government only during such crisis when it puts in money, not when it shows austerity. If government also does not spend, then who would? So, survey strongly suggests that to unleash the animal spirits of economy, credible commitment needs to be shown by the government, and this is possible only by adopting an active fiscal policy. Now, what is the argument? High debt leads to lower growth. So, this is the Ricardian wala concept that if you have very high debt now, if you borrow and spend now, it may lead to lower growth in future. What is the logic? High debt, you have to service those debts in future, so more taxes in future. If there are more taxes, there is less lifetime wealth with people. If there is less wealth, there is less consumption and less savings. This will translate into less aggregate demand, which in turn would mean lower economic growth in long term. But then, as I said again, survey clearly says that this is not the way in India. Why? Survey says that the debt that we take today will not result into lower growth in future. Survey gives calculations and uses certain concepts to explain that the debt that we are taking today is sustainable. It will not affect growth negatively because of the drivers. And what are the drivers? IGRD, interest rate growth rate differential. The survey says that if we compare the interest rate and the growth rate of the economy, the interest rate in the economy and the growth rate of the economy, if the growth rate is more than the interest rate, so the IGRD should be effectively negative. So if the IGRD is negative, this means the growth rate is more than the interest rate. In long term, it would lead to debt being sustainable. This means if your economy is growing at a faster rate than the interest rate in the economy, it would be perfectly normal for your economy and possible for your economy to pay back the debt that you've taken. Right? You will not be overwhelmed by that debt. You will not. It will not lead to defaults. So, survey through calculation shows that this interest rate growth rate differential over the next couple of years for India is going to be negative. It has been negative and it will be negative. So if it is going to be negative, the growth rate of India is going to be larger than interest rate. So the debt that India will take now or is borrowing is not going to be unsustainable. Second, debt to GDP ratio in the previous period, it has been clearly been shown that India, it's nicely controlled, the debt to GDP ratio. And globally, if you compare, we have this ratio is less than the global average. Also, it speaks about the ratio of primary deficit to GDP. Now, what is primary deficit? It is the difference between current year's fiscal deficit and the interest payments on previous borrowings. So, the fiscal deficit that is today, maybe say 9%, whatever it is, and the interest payments on previous borrowings. So, if this difference, that is primary deficit, is below a particular threshold, we cannot discuss about the threshold here. It's a complex calculation that the survey has given, but the survey clearly makes the point that if the primary deficit is kept below a particular threshold, in due course of time, the increasing growth rate of Indian economy will lead to decline in primary deficit. So, you borrow, you spend, it leads to greater economic growth that reduces your primary deficit. And if the primary deficit is kept within check, within a particular threshold, it would not lead to increase of your IGRD. It will not make your debt unsustainable. So, the bottom line of all the discussion is that Indian economy, debt to GDP ratio is well, our IGRD is negative, and our primary deficit is in control. And in future, if we grow well, this primary deficit will anyway reduce. So, taking these three factors, our debt is not going to become unsustainable. So, just look at this chart. It's very interesting. Contemporaneous relationship, GDP growth and change in general government debt. So here survey makes a very interesting point. It says that on y-axis we have change in debt to GDP ratio, and here we have the real growth rate. So if you observe, what you see here is a negative relationship. So here Normal interpretation would be, if the debt is high, debt to GDP ratio, if you look at this point, right? If the debt to GDP ratio is high, the economic growth is low, right? That's what we see here. If the debt to GDP ratio is low, the economy's growth rate is high, right? So this is one way of looking at a diagram, which says that if debt to GDP ratio is high, growth rate is low. Debt to GDP ratio is low, growth rate is high. But the interesting point is, economic survey makes a counterintuitive argument here. It looks at this relationship or this causality in a reverse manner. It doesn't say that when the debt to GDP ratio is high, economic rate is low. Rather, it says that the causality is reverse. When economic growth rate is high, the debt to GDP ratio is low. It is just you turn the causality. So it is not that high debt lead to low growth. Rather, survey says high growth leads to lower debt. So if you look at this dot, right, it is not low debt which brought this growth. Survey says it is this growth which has reduced the debt to GDP ratio. And that is the basic argument this chapter is trying to make. The relationship not applicable to advanced economies. So if you look at the advanced economies like US or European countries, they grow at a very less growth rate. That is why this relationship that the survey is trying to bring up in the Indian context is not applicable to advanced economies. Even survey says that the structure of India's public debt is such that we don't have to worry too much. We can borrow and spend. What is this structure of public debt? India's public debt to GDP ratio low compared to global levels. The public debt in India and the overall debt has been declining since 2003, and it has been stable since 2011. So our debt position, the fundamentals are well maintained. Even in the external sector, the debt, out of all the debt, external debt, that is what the country has borrowed from outside, is only 2.7% of GDP. So most of it is domestic borrowing. This also reduces the foreign exchange risk. So there is low forex risk or external risk as we call it. Of the total public debt, 70% is held by center, right? So only 30% is held by states, and this means that the center is in perfect control of what is happening in the economy. So we don't have to worry much in long term. RBI will take care of it. Also, the survey says that the long maturity profile, along with small share of floating debt rate. So whatever the debt we have, most of it is for long term. That is why we don't have to worry about the repayment in short term. So most of it is long maturity profile. Plus floating debt rate is less. So even if the exchange rate goes up or down, it's not going to affect your repayments in short term, because very small portion of our debt has a floating debt rate. So overall, the survey is trying to say that the public debt in India is such that it is mostly domestic, less external, mostly held by center, not states, and most of it is long-term profile. So we don't have to worry much even if we borrow now. But then what do we need to watch for? We need to watch out for inflation, because today, because of the COVID, the demand and the supply both are affected. So if you borrow too much and spend too much, it will boost the demand in the economy. But unless the supply chains are back on track, it may lead to demand pull inflation. Also, if you are increasing the fiscal deficit, which the government already has, how the FD is deployed is important. Here, the survey gives the experience of Chilean government and the copper exports and regulations and so on. You can read it in the survey. So overall, the argument is, if the fiscal deficit that has been created is used, the money is used, the spending is used in a productive manner, then it will lead to economic growth in future, and it will allow us to repay the debts that we have taken now. If the fiscal deficit is only used for consumption or committed government expenditure, you know what I mean, right? It would be problematic. This one chart by IMF, right, October 2020, World Economic Outlook. This is a bit troublesome, because it says that GDP losses 2019 to 2025, right, 2019 to 21, overall potential for long-term impact of COVID crisis on growth. India is on the top right corner. So the probability of impact of COVID to last on Indian economy for a long period is very high, and so we need to be very careful about the steps that we take now. What has the budget done? It has gone for high fiscal deficit. So consolidation is not on charts now, but it was required. It is the Keynesian macroeconomics, right? Counter cyclical fiscal policy. The growth rate is not going to be very high as of now, but we look forward to next fiscal or a year or two down the line that our economy may come back on track. This COVID presents a demand and supply shock. We need to be very careful, and in a staggered manner, we need to bring the economy back on track, taking into consideration the ability of supply chains to come on track again. It is worthwhile to mention that this budget is focused on infrastructure, the national infrastructure pipeline. So this is an intelligent move by the government where infrastructure would generate jobs. It would also increase the supply chains and productive capacity of the economy, so that the growth that is gained would make today's debt and today's spending worthwhile, and it will justify it. Lastly, there's a question that I want to raise, that what when we are speaking about just infrastructure, what about the human capital and social expenditure? Because whenever budgets contract, we know that the first hit is taken by social sector expenditure. Plus, this is the first economic recession or crisis that the world has landed in because of health reasons. So the origin of this crisis has been in social sector, health, education, and so on. So here, if health is most important thing, then in the present context, India needs to focus on not only the hard infrastructure but also the human capital. It needs to focus on hospitals, the physicians. It needs to on drugs, research and development, and all this human and social expenditure. It needs to be focused. So this is about the second chapter. I request you to subscribe to the channel. Until then, think, discuss, and debate. I'll come with the next chapter very soon. Thank you.